Welcome back to Silver&Metal IQ, your go-to source for the latest in gold, silver, and precious metals. I'm Peter, and today we're going to unravel a story that isn't just about prices. It's about national sovereignty, global finance, and the shift from paper promises to real, physical assets. If you think silver is just a commodity, think again. What's happening right now is unprecedented. Superpowers like the United States and China are openly accumulating silver and gold, classifying them as critical minerals, and integrating gold into trade settlements instead of relying on treasuries. This isn't speculation, it's a strategic movement reshaping the global financial landscape. The BRICS alliance is now settling trade balances in hard assets, supported by the expansion of the Shanghai Metals Exchange and the establishment of vaults across the Belt and Road Initiative. Gold and silver are being treated not just as investments, but as sovereign wealth protection and critical industrial assets. For the first time, the world sees that delivery matters. Countries are standing for physical delivery, not paper contracts. And this shift is cracking the decades-long control that Western derivatives markets have had over precious metals. Today, we'll explore why this matters to you as an investor, a trader, or simply someone looking to preserve wealth. We'll cover the mechanics of delivery, the rise of physical accumulation by nation-states, the decline of U.S. Treasury dominance, and how this fundamentally alters the silver market. By the end of this video, you'll understand why the era of paper promises is over, why physical ownership is becoming critical, and how these shifts could impact your financial future. So buckle up, take notes, and stay with me, because what's unfolding in silver and gold right now is bigger than anything we've seen in decades, and could redefine wealth preservation for generations to come. The shift we're witnessing in the precious metals market is historic. For decades, paper contracts dominated silver and gold trading, with Western banks effectively controlling supply through derivatives. Delivery was rare, and most investors relied on the illusion of liquidity. That's changed dramatically since 2020. Countries like China, Russia, and India are now actively taking delivery of physical metals. Less than 1% of contracts previously stood for delivery, but today, sovereign powers are demanding their metal, and in quantities that dwarf the supply held by exchanges like COMEX or the LBMA. This movement represents a deliberate challenge to Western financial hegemony. Superpowers are openly accumulating critical minerals, classifying silver and gold as strategic assets, and prioritizing physical settlement over paper claims. The Shanghai Metals Exchange has expanded its reach, creating vaults across the Belt and Road Initiative, from Hong Kong to Saudi Arabia. Gold is being integrated directly into trade settlements, bypassing U.S. treasuries, and creating a parallel infrastructure where sovereign wealth is protected against currency devaluation and geopolitical risk. Silver, in this context, is equally critical, essential for industrial applications, high-tech defense systems, and long-term national security planning. The mechanics of delivery have also transformed the market. In the past, raising margin requirements successfully forced leveraged investors to liquidate positions, suppressing prices. Today, these margin hikes serve a different purpose. They shake the bushes, flushing out weak hands while leaving deep-pocketed sovereign powers to acquire physical silver at favorable prices. Entities like the People's Bank of China, India, and Saudi Arabia are immune to margin calls. For them, short-term price volatility is an opportunity to accumulate assets rather than a threat. This shift from speculative paper trading to strategic physical acquisition is fundamentally altering market dynamics. Industrial demand further compounds the pressure. Nations are stockpiling silver not just for monetary reasons, but to meet the needs of advanced technologies. Companies like Tesla, Samsung, and Sony are investing in mining and refining operations globally, including previously dormant sources in Mexico and China, to secure doré concentrate. Meanwhile, governments are imposing export limits to preserve domestic supply, ensuring that strategic priorities are met before excess metal is sold on the open market. These coordinated actions are slowly breaking the old system where the West could suppress prices through paper contracts. Moving forward, this evolution reflects more than a market trend. It signals a global shift in sovereignty and financial independence. The dominance of U.S. Treasuries is waning, and paper-silver markets no longer dictate the fate of real metal. Sovereign buyers are rewriting the rules, turning physical delivery into the ultimate measure of control. For investors and observers, the lesson is clear. Understanding who is standing for delivery and why is now critical. Physical metals are no longer just a hedge. They are a cornerstone of strategic wealth preservation in an increasingly multipolar world. One of the most fascinating aspects of the current silver market is the way sovereign accumulation is exposing the limitations of traditional trading mechanics. In the past, Western banks controlled the market through paper contracts, derivatives, and margin manipulation. When prices rose too quickly, exchanges like COMEX would raise margin requirements, forcing leveraged traders to sell positions. This shake-the-bush strategy successfully suppressed silver prices in 2011, leaving the market broken for years. Today, however, this tactic is no longer as effective. Sovereign entities, trading with cash rather than credit, are immune to margin calls. For them, these artificial dips are opportunities to scoop up physical metal at discounted prices rather than threats to their positions. This change in dynamics is evident in recent movements. Reports indicate that J.P. Morgan and other major U.S. banks have shifted to long positions in silver, covering hundreds of millions of ounces in short contracts, while only a handful of European banks remain short. As prices rise, these remaining short positions are increasingly squeezed, demonstrating a structural shift. National wealth and coordinated sovereign action are now the dominant force in silver trading. The days when leveraged hedge funds could dictate the market are over. Physical delivery is becoming the true benchmark, and paper contracts are increasingly secondary. Margin mechanics continue to shape volatility, but the outcomes have fundamentally changed. For example, a Christmas Day scenario in recent years illustrated this perfectly. Traders could control large contracts with a relatively small margin, only to see margin requirements raised by 30% the next day. This forced weak hands to liquidate, driving the price temporarily down. But instead of crushing the market, these actions simply allowed sovereign and deep-pocketed investors to acquire more physical silver cheaply. The Western strategy of suppression has been neutralized by the sheer scale and sophistication of global buyers. Industrial demand is also influencing market dynamics. Companies like Tesla, Samsung, and Sony are not merely speculating, they are strategically acquiring silver for essential industrial processes. China has been paying double what Western buyers offer for door concentrate and shipping it home for refining, ensuring their domestic supply is prioritized. At the same time, countries are restricting exports to protect national interests. This combination of sovereign accumulation and industrial demand creates a scenario where every ounce of silver is highly contested, fundamentally limiting the ability of Western banks to manipulate the market. Moving forward, the current market is no longer about speculation. It's about control, delivery, and national sovereignty. Sovereign powers are demonstrating that they can dictate terms by demanding physical delivery, absorbing market dips, and reshaping the very mechanics of trading. For ordinary investors, the lesson is clear. Understanding the forces behind these movements, the importance of physical silver versus paper contracts, and the strategic intent of global buyers is critical. Those who fail to grasp this shift risk being left behind as silver becomes not just an investment, but a strategic asset in the new multipolar financial world. The global financial landscape is undergoing a seismic shift. The BRICS alliance, Brazil, Russia, India, China, and South Africa, is actively moving away from U.S. treasuries and toward hard assets like gold and silver for trade settlements. Gold is being reintegrated into monetary systems, with the Shanghai Metals Exchange expanding its network and vaults being strategically placed throughout the Belt and Road Initiative. From Hong Kong to Saudi Arabia, these vaults allow countries to trade local currencies and settle balances in physical gold, bypassing the dollar entirely. This movement challenges decades of Western financial dominance and marks a historic shift in global monetary policy. Silver plays a complementary role in this system. While gold secures macro settlements, silver is critical for industrial applications in advanced economies, ranging from AI data centers to high-tech manufacturing and defense systems. The United States, China, and the European Union have all classified silver as a strategic critical mineral, and export limitations are increasingly used to prioritize domestic needs. This creates a market environment where industrial demand meets sovereign accumulation, resulting in tight supply, higher premiums, and long-term upward pressure on prices. Unlike paper contracts, these physical holdings represent tangible control and sovereignty. The mechanics of delivery continue to reshape the market. Today, sovereign powers, hedge funds acting on their behalf, and industrial buyers are the entities standing for delivery. They operate without reliance on leverage or credit, absorbing any temporary volatility created by margin hikes. In 2011, such margin-based interventions crushed the market, leaving small investors and paper holders underwater for years. Now, however, these interventions act as a mechanism to transfer ownership from weak hands to those with deep pockets, strategic foresight, and national objectives. Temporary dips are opportunities, not disasters, as physically backed entities accumulate silver relentlessly. Meanwhile, U.S. banks and European institutions with historically massive short positions are being squeezed. As sovereign and industrial demand grows, paper short positions are increasingly unsustainable. The market is witnessing a realignment of wealth and power, where nations and industrial conglomerates dictate terms rather than speculative traders. This is not merely a financial trend. It reflects the new geopolitical reality, where economic influence and physical assets define national security. Governments are no longer passive observers. They are active participants, ensuring that critical metals remain under their control. Moving forward, the broader macro context cannot be ignored. Decades of debt accumulation, currency devaluation, and the erosion of trust in fiat systems have fueled this migration to tangible assets. Investors and governments alike are recognizing that paper promises have limits and that real delivery of gold and silver matters more than ever. In this evolving landscape, understanding the forces at play, from BRICS monetary strategies to industrial demand and sovereign accumulation, is crucial for anyone looking to protect wealth, navigate market volatility, and comprehend the future of global finance. The current silver market is defined by an unprecedented convergence of factors. Supply is constrained while demand is exploding, both from industrial users and sovereign entities. The LBMA reports roughly 140 million ounces of deliverable silver against 2 billion ounces of outstanding contracts, a massive imbalance that exposes the fragility of paper markets. For years, Western banks used this leverage to suppress prices, selling far more on paper than existed in vaults. Today, sovereign powers and industrial buyers are standing for physical delivery, and the old tactics of manipulation are increasingly ineffective. Temporary price dips created by margin hikes or speculative selling are quickly absorbed by these deep-pocketed, well-informed participants. JP Morgan exemplifies this new reality. Recent reports indicate that the bank has flipped long, covering a 200 million ounce short position in silver while purchasing millions of ounces of physical metal over the past 6 weeks. Meanwhile, most other U.S. banks are also long, leaving only a few European banks massively short. As the price rises, these short positions are being squeezed, demonstrating the structural shift from paper dominance to physical accumulation. What previously worked to suppress silver, margin increases, forced liquidations, and leveraged shorting, now simply transfers ownership from smaller traders to nation-states and industrial giants who are immune to these interventions. Industrial demand remains a critical factor. Companies like Tesla, Samsung, and Sony are securing silver for domestic production, often paying significantly above market rates for raw ore concentrate. China has been actively purchasing and refining ore from miners for the past 2 years, prioritizing strategic control over cost. This coordinated industrial and sovereign activity ensures that physical silver is absorbed as quickly as it enters the market, leaving limited opportunity for speculative accumulation. This is a fundamentally different environment from 2011, when Western manipulation crushed prices, leaving small investors underwater for years. Margin mechanics illustrate this shift further. In recent market events, traders controlling large silver contracts with relatively small margin deposits faced sudden increases of 30% or more. For leveraged traders, this forced rapid selling, temporarily driving down prices. Yet these artificial dips were seized by sovereign buyers as opportunities to acquire physical silver at discounted rates. The system that once punished markets now rewards those with liquidity, foresight, and physical holdings, fundamentally altering market psychology. The era when paper contracts dominated supply and dictated prices is ending. Physical ownership and delivery are now paramount. Moving forward, the broader implications for investors are clear. Physical silver is no longer just an investment hedge. It is a strategic asset, a store of wealth, and a critical industrial resource. Sovereign accumulation, industrial demand, and the exposure of short positions create a market environment where only those who understand the mechanics of physical delivery and the forces driving global acquisition can successfully navigate volatility. For anyone seeking financial security, this is the moment to recognize the value of tangible assets, understand market mechanics, and prepare for the era of physical dominance in precious metals. As we close this series on Silver&Metal IQ, it's essential to understand the bigger picture. What we are witnessing in silver and gold is not just a financial trend. It is a reflection of profound structural changes in the global economy and geopolitical order. For decades, Western banks and financial institutions controlled precious metals through paper contracts and derivatives. Physical delivery was rare, and the market largely rewarded speculative behavior over real asset ownership. But today, that paradigm is shifting. Sovereign powers like China, India, and Saudi Arabia are not merely buying silver. They are standing for delivery, securing physical assets, and reshaping global supply chains to prioritize national security and industrial sovereignty. This shift has significant societal implications. Ordinary citizens are often unaware that the foundations of financial security are changing. With fiat currencies under pressure from debt, inflation, and systemic mismanagement, traditional assets such as U.S. Treasuries are losing appeal. Countries and institutions are seeking Tier 1 assets that have no counterparty risk, tangible value, and industrial utility. Silver and gold fulfill all three roles. Unlike paper contracts, which can be manipulated or defaulted on, physical silver and gold retain intrinsic value and provide security in uncertain economic times. For investors, this is more than an opportunity. It is a necessity for wealth preservation in a world where trust in fiat currency is eroding. The acceleration of sovereign accumulation has also created a new market dynamic. Temporary price drops caused by margin hikes or speculative selling no longer destabilize the long-term trend. Instead, they act as opportunities for well-funded buyers to acquire physical silver at discounted rates. Unlike 2011, when leveraged traders were crushed and prices remained suppressed for years, today, the market absorbs these fluctuations because those who are truly standing for delivery operate on capital strength, strategic foresight, and long-term objectives rather than short-term speculation. The shift from paper dominance to physical control is redefining how wealth is measured and preserved on both national and individual levels. Industrial demand amplifies this trend. Silver is critical in advanced technology, AI systems, defense infrastructure, and renewable energy applications. Companies like Tesla, Samsung, and Sony are actively securing supply, often paying premiums above market rates to ensure they meet production needs. Meanwhile, nations limit exports to protect domestic requirements. This combination of industrial and sovereign demand ensures that every ounce of silver is strategically valuable, not just a financial instrument. Investors who understand this context recognize that owning physical silver today is not speculation. It is participation in a market defined by scarcity, necessity, and geopolitical strategy. Looking at the broader macroeconomic picture, the decline of dollar supremacy and the integration of gold and silver into global trade settlements signal a structural realignment in financial power. The BRICS alliance, expansion of the Shanghai Metals Exchange, and multi-jurisdictional vaults along the Belt and Road Initiative are creating a system where value is defined by physical assets, weight, and purity, rather than faith in a fiat system. Countries are increasingly prioritizing real assets over treasuries, protecting themselves from sanctions, currency devaluation, and fiscal irresponsibility. In this environment, silver is not just a commodity, it is a strategic pillar of national and economic security. For individual investors and viewers, the takeaway is clear. Understanding who is standing for delivery, the role of physical versus paper silver, and the forces driving sovereign and industrial accumulation is crucial. While volatility remains, the long-term trend favors those who hold tangible assets. Physical silver and gold are shields against systemic instability, hedges against inflation, and tools for preserving purchasing power. This is the reason why smart, well-informed participants are willing to spend billions to secure supply. They are not speculating on price. They are safeguarding value. Finally, a financial disclaimer. All information shared in this series is for educational and informational purposes only. Precious metals are volatile assets, and trading futures, options, or paper contracts carry significant risk. This content does not constitute financial advice, and viewers should conduct their own research, consult qualified professionals, and carefully evaluate their risk tolerance before making any investment decisions. Past performance is not indicative of future results, and while silver and gold offer protection and strategic value, no asset is completely risk-free. Thank you for following this 6-part series on Silver and Metal IQ. Understanding silver is about more than profit. It is about awareness, strategy, and securing your financial future in a world where traditional systems are increasingly unstable. Stay informed, stay vigilant, and prioritize tangible assets in your portfolio. The era of paper promises is ending, and the future belongs to those who hold real physical wealth.